Hey there, welcome to this video. So investing in just one stock can surpass your full-time job in terms of its income. And I'm going to be sharing with you a bunch of stats and examples to help you understand this opportunity when it comes to investing in individual businesses. And the reason why I'm making this is a couple weeks ago, a guy reached out to me on Reddit. He has a family, he's in his 30s, he's been saving up money, investing in index funds, paying down his house. So like all the things that you're supposed to do from a financial point of view, but he realizes that he's still got to stay in the rat race because the returns aren't high enough for him to quit his job. So he's asking me, can I actually value and study businesses to ultimately escape the rat race and go investing full time? So that's what we're going to talk about here. I'm going to be jumping back and forth between showing you data and explaining it so that you can understand that opportunity for yourself. And I might be coming at it from a slightly different perspective because I'm Henry Chien and I've been analyzing companies for 10 years. I was working on Wall Street as a research analyst at Bank of Montreal, capital markets and investment bank. So I'm coming at it from more of a professional investing world perspective. So hopefully a lot of what I can share with you haven't heard before, and you can understand why there's an opportunity there. First question, is it actually feasible to value and buy good businesses to get to that financial freedom number? And more importantly, to get there faster than using like the VTI, so an S&P 500 index fund? And the answer is yes, but it's not the way that you might think. So first off, we got to understand the stats of where the returns coming from investing in the S&P 500, because if we want to get a higher return, we have to understand what we have to do different. So the S&P 500 works because historically it's grown at about 10% every year, but that's over the long run. So a market cycle is about 10 years long. If you want to look at history of returns, I would recommend going to Yardini's research. He's a great strategist. And you can see that the market cycle typically 1 to 2 years are always a bear market. So the market goes down. And then 8 out of 10 years, the market historically has gone up. And over the long run, that's how you get that 10% every year for the long term. And that's great. But what you probably don't know, if we start to dig in deeper into where the source of those returns are coming from, is that for the past 100 years or so, it's really only 4% of all the companies in the US have driven 99% of all the wealth. So meaning 4 out of every 100 stocks are really driving the entire wealth creation of the entire market. And this comes from research from this guy, Hendrik Bessenbinder. Here I pulled up, you can see the chart of where the wealth creation basically is just concentrated in the top 4% of companies. If you want to look in the paper itself, it's called Do Global Stocks Outperform US Treasury Bills? But that's the basic takeaway of that. So therefore, in order to get a higher return than the S&P 500 index, you have to own a lot more of these companies, these 4 out of 100 companies. Now, that might not seem like a lot, right? But if you think about it, 4 out of 100 means that if you're looking at 25 stocks, it's 1 out of 25 will probably be a gem. So it actually is a lot more common than you might think. And also, the reason why the S&P 500 works is because if you think about it, you have 500 stocks. If 4 out of 100 are going to be really great companies, so times 5 means that's you're owning 20 of those amazing companies, and that's where your returns are coming from. And the reason why it's S&P 500, not 400 or 200 or 300, is that studies have shown over time that 500 is that optimal diversification number to get really good companies without sacrificing returns by diluting it over too many companies. So point is, therefore, you only need one of those companies, and to get a higher return than using the index, you have to have a higher percentage of your portfolio in that stock. So now this is starting to seem doable, right? Now, but this does not mean that I want you to go out and start selling your index fund and start creating a new portfolio and start picking stocks right away. There's a second function that the index is doing that also might not be well understood, which is that it's market cap weighted. Now, market cap weighted means that the index is automatically buying more of a company as it grows in value. So it's naturally concentrating on the bigger companies, the more valuable companies that the market perceives as more valuable. And because in every cycle, every type of environment, the best company usually changes depending on what's going on in the economy and which companies are doing better. So the index is naturally concentrating because of that automatic rule on those best companies in every time period. That's also how you're getting those really good returns. If you look in the composition of the S&P 500, you can see that right now the top 10 constituents are 37% of the index, right? The top 10, if we look over here, you can see are all the companies you're probably aware of: Apple, Nvidia, Microsoft, Amazon, Tesla. And so that's a good thing because the index is naturally concentrating on some of these best companies in the world. And that's how you're able to get these great returns, by basically doing nothing. If we think about the high level opportunity over here, there's 3,000 stocks in the US. 4 out of 100 are going to be amazing statistically. So that means there's about 120 amazing stocks that you can buy. And then your only task is just to concentrate your portfolio, have a higher percentage in those stocks. Now, but of course, if you're new to this, it's going to take a little time to learn to recognize them by doing the analysis and understand what makes a good company. So you don't want to get rid of the benefits that you get from the index, but you still want to get the additional returns from those great companies. So how do you do that? So here's an example. This is something I outlined in my book of how you can get both the benefits of the index as well as the benefits of potentially picking a great company and concentrating on it. Now, let's say we go into 2016, 2021. I'll just pick that period as a sort of mini cycle. We had a mini recession in 2016, mini recession or big recession in 2020. And let's say you put $100,000 in that S&P 500 fund. So in the index scenario, that return of the S&P 500 was 100% over those 5 years, right? Like that's pretty good. Now, we started thinking about potential scenarios of, let's say we take 10% of that portfolio and invest it in an individual business. Now, there's basically 3 things that could potentially happen. One is we pick a terrible company and it goes to 0. That's the worst that can happen when you start to invest in an individual business. Second thing is, say we're just a little bit lazy. We assume we already own one of those great companies. We just pick one of the top 5. We say it's Google. We think it's a great company. So we put an extra 10% in Google. Third is like we do the actual research and start studying companies. We study 25 companies. We come across, say, like a restoration hardware. We found a company that's doing really well at the time. And that idea may have come across because, say, if you're starting to buy furniture and you realize like people are talking about restoration hardware, it looks really nice. You look into it, you realize there's a new CEO. He's bringing this whole brand up market. Financials are doing really well. The company is really expanding. So we put 10% in each of those scenarios. Now, what happens when we do that? The returns are actually quite asymmetric. You have a lot more upside once you start picking companies. If we just do the base case of just S&P 500, so that's that yellow line over here, base case is 100%, right? Now, if we picked a terrible stock, our return obviously drops and it goes down to this worst case, which is we're just up 80%. So we lost about 20% in returns. Now, if we concentrated in Google, that's our lazy case, we're about 110%. And if we invested 10% in restoration hardware, that's the best case scenario, picked a really great company, we're up 310%. So 310% versus 100%, you're getting that extra 200%, like that's meaningful, right? Like just very simple. If I simplified it, that's probably about 10 years of work you just pulled forward in those 5 years from work of saving and investing, right? So that's where that just one stock can start to really accelerate you to having enough money just to get to your financial goals. So and you might think at this point, like in hindsight, like, well, Henry, you just cherry picked that idea. And yes, of course, because we're looking at businesses and it's always different businesses that are happening that are outperforming at times. And if we look at restoration hardware now, obviously the business has contracted a little bit in 2021, past 2021, because retail is just a more volatile sector. But the point I'm trying to make is that there's a lot of good companies out there that you probably know of that can be one of these great companies. So for example, let's say, how about FICO? If you've ever done a credit check or got a credit card or got a mortgage, you probably got a FICO score. That company's done even better. It's probably 10x since there. So it's up 400% over the past 5 years versus the S&P up 100%. Or maybe, let's say you've been trying to eat healthier over the past few years. You may have come across this new grocery store called Sprouts Farmers Market. If I put that company in, right, that's been up almost 700% over the past 5 years, or 600 plus. Super meaningful. For me, because I was working in finance at the time, I noticed it was MSCI because everyone was buying ETF and index funds. And so that did a lot better in that 2016 to 2021 period, but still is not too shabby, outperforming the S&P. MSCI is like a data provider for ETFs. So at the time when I was recommending it, between 2017 and 2021, that was up about 700%. So these companies are out there. I'm telling you that the point is, like, these ideas are everywhere. So then why can't you do it yet, right? Like, that's the question. Like, why can't you do it? And that's a fair question. And I think the reason is, especially if you've been reading things like The Intelligent Investor or Rule Number One. So those are great because I think they've opened up your eyes to what's possible, that you can identify a good company. And if you can value it and buy it at a good price, you can make a lot more money. But then why is it not working for you if you've tried? And so I'm going to make an educated guess here. You can let me know in the comments if I'm wrong. But what you probably did when you're trying some of these methods is you probably pick something that you heard of, something like a Starbucks, right? I like coffee, I buy stuff there, and I see a store on every block, and I should buy what I know. Warren Buffett says, stay within my circle of competence. I understand what a coffee shop business is like. I started to look at the financials, and so I'm going to buy Starbucks. And so let's say you did that in 2015. And so now I pulled up Starbucks, their financials. This is on Koifin, by the way. And say you bought it in 2015, right? Like, because the business has never been better. You're looking at the financials, you're like, wow, there's great growth. Growth has gone to 16%. Return on equity is now, well, let's go to the highlights. The return on equity is crazy. It's 50%. And I see that the earnings per share has almost doubled over the past couple of years, right? Record earnings. And so what happens over the next few years? Well, counterintuitively, the stock does nothing. See, the thing is, everything that you thought was good potentially was a warning sign, right? Because when a company has reached this sort of peak growth, the market was potentially maxed out at the time. Maybe there was too much competition, too many coffee shops, they're investing too much. Basically, the growth is peaked and now starting to slow down. And because when you have these record earnings, the market valuation of Starbucks was actually really high at the time. It was like 30 plus times price to earnings ratio, which is quite high for Starbucks. And so because growth slowed down over the next few years, the expectations also had to come down. That's why this stock between 2015, when you bought it, when it was doing really well, this business, over the next 3 years, the stock basically did nothing. So the problem, if you can see it, is that all your life with these investing materials, you've been just trained the wrong way. You've been trained to study historical financials, whereas the market is always just trying to price the future. And therefore, if you're studying the historical financials and you extrapolate or just make up some sort of earnings forecast, you're not actually estimating the future correctly. And you also run into the error that the market is trying to price in something. And if it doesn't turn out to be that really great expectation that you estimated, things change. And then that's how you lose money. The stock revalues to price in the actual reality. And you got to remember, if you're, trusting someone like Ben Graham, it's a great book, The Intelligent Investor. He wrote that one, is that he was looking at railroads at the time, right? Much different businesses, super, super predictable. That's why you can get away with just looking at a historical trend of railway traffic. I mean, Buffett still invests in railways and assume that historical trend can continue because railroads don't change that much. You can't really build a new railroad. So it's just based on just flows of transport flows, and they don't change that dramatically versus like a company that's growing like Starbucks. And so I also bet you didn't know this, is that Ben Graham, his philosophy, if you probably take away from The Intelligent Investor, is buy like these really stable companies and buy them at a low price to earnings multiple, so a low valuation. But you probably didn't know that the stock that made Ben Graham's performance great was not any of those companies. It was Geico. And Geico is not a cheap company. It was not an established business at the time. It was a small growing insurance company, and insurance was like a growth industry at the time. And that one company is what changed Ben Graham's performance. You can look it up. And this little company, Geico, also turned out to be Buffett's favorite company. I'm going to show you this article back in 1951. This is Warren Buffett talking about the security I like best. It's Geico. He's talking about how it's a growth company, is trading at a reasonable valuation, and that's his favorite company. He eventually bought the entirety of Geico, and then that is the foundation of Berkshire because that insurance money gave him all the capital to invest. So the point is, when you're looking to get that one company that's going to really change your future, is you're not just looking for a stable company. You got to look for a company that's going to be really big in the future. and of course, buy it at a reasonable price. Now, you might have wondered, okay, great. So are professional investors doing something different, and does it work? So I'm telling you, yes, they are doing something different, and yes, it does work. Now, you don't have to take me at my word. So I want to show you just an example of, you can look at any sort of equity research report. So I'm going to pull one up here. And if you just ignore the recommendation, so I pulled up my own just because I have my own research saved. You want to see how people structure the investment thesis. So what you're going to do is you're going to see a lot of numbers, like over here with the financial statements, the different valuation scenarios, and all this stuff on the, in the report is just analysis to understand how the business works. And then all the analysis ultimately goes into some kind of financial input, goes into, there's a whole mess of numbers here, but essentially goes from financial inputs to become a financial forecast. So if we were to look at an equity research like Starbucks, you would see things like same store growth rate, which is just the estimated normal growth of a store, plus store openings, so expansions, plus any investments required to grow those stores. And then how does that all flow into what the earnings are for the future of the business? So therefore, the entire report, like you can see over here, is just to estimate the future earnings of the business and then start to value it, right? So these are all numbers just to value to estimate the future financials, and then have things like valuation methodologies, upside downside. So it's all just different ways to estimate how the market is going to value the business. And that's the thesis. So the point is, you get these things right, you understand the future financial projections of the business and understand how the market will value it. And that's how you start to make money. That's in a nutshell what professional investors do. Now, so then you might ask, like, okay, so if it's so straightforward, why is every single mutual fund underperforming the index? And which is true. And I'm going to tell you exactly why from working in the industry. So these are all legacy products. Most of these firms were actually created before index investing was even possible. So when you pull up any sort of mutual fund, so I'm pulling up Fidelity here, and Fidelity is not to pick on them. It's probably actually a really good fund. They're a really, really great firm. But if you want to look at the composition of this fund, you can see that there's 399 stocks in here. So anywhere between 3 to 500 companies, if it's a pretty big fund. That's a lot. And the reason why they're designed that way is because they weren't designed to give you higher returns than an index. They were designed to give you an exposure. So this fund is giving me large cap growth, right? You can get growth, you can get value, whatever, mid cap, small cap. They're designed to give you exposure to those type of stocks because, again, they were made before an index was even investable. And you couldn't do it with an index at the time. So that's why they're structured that way. And that's why they're all built with these rules that they can't invest too much in a few stocks. They can't deviate from the index. That was considered a bad thing. And they have to stay within those type of stocks. Like, they were designed to be an index. So if you think about it, if they're just constructed like an index, how much more returns can you really get than an index? Maybe like 1 or 2% more max. You layer on top the fees. Now, thankfully, fees have come down, but they're all about like maybe 1%. Their fees are their fees are really good. Anyway, so the fees are usually 1%, 1.5%, or even less. So Fidelity is now being a competitive one because large cap is super competitive versus the index. Just basically index fund at this point. But what happens with those funds that still charged at 1% or so, any additional returns they're getting are just getting eaten up by those fees. Now, if you remember, statistically, where do the returns come from above the index? They come from a few winners. So in order to outperform the index, you have to concentrate on those winners. Now, to see this in actual practice, if we look at funds like Barron's or Jennison, and I bring these up just because they were clients of mine, I knew that they were really good investors, is their performance starts to be really different when they have a different strategy. So Barron's, this one is the, the global or the opportunity fund. This one can concentrate. This one is not stuck within any sort of framework of having to invest a certain percentage or maximum percentage in any stock. They can look at different stocks. So this one, they can focus more on like tech and innovation, even if they still focus on large cap companies. But the point is, when you can start to invest differently from the index, your performance gets different. So their performance, they're a great investment firm. So you can see that their performance is much better, 10% versus like the 8% since the 2000s. And another thing that you can look at, oh, I just lost it. So you can see the tracking error is quite high, which means they're deviating from the index. Another thing you can look at, where is it? Okay, active share. So active share is one measure that people started to use at some point in the mutual fund to try to measure whether or not they're being different from the index. So the problem is with the mutual fund industry, why it doesn't really exist that much, and I kind of feel bad for these companies, is that this is what's been going on in the world. Most flows have been going away from these mutual funds and going into index funds. So most of these firms are just struggling already. They just don't have the capacity, like Barron's or Jennison or even Fidelity, to launch new strategies that are really focused on beating the index. They just can't. And so there's a ton of great investors, really great professional investors out there that are just stuck in the structure, right? Like they can maximum generate 1% to 2% additional returns, and most of that will probably be eaten up in fees to pay for these big companies. If you look into the hedge fund space, then you might be able to see more stock picking, but they're also in this really constrained structure. They have to do like alpha return type of stuff, which is another discussion for another day, but they're also very constrained as well. So the point is it's not really any kind of magic to be a good investor, to make really good returns as an investor. It's really just comes down to analyzing and understanding a business. And when you do that, you start to have the different pieces to forecast. And then that gives you a sense of the future earnings. And then you just have to be able to value it based on the way that the market's going to value the company in the future. And that's why you get these dynamics where you have to be sure that the market is not pricing in what you're seeing. Because if the market is already valuing the company with this really great growth expectations, even when that happens, you might not get paid. Whereas the reverse happens if you see a company that's going to perform better, but the market's not pricing in, you make a lot of money. So example, to make that a little bit less abstract, is Tesla. So Tesla has gone up a lot in 2024, right? And it basically almost doubled. So what happened was Tesla was going through a little bit of a contraction period. So if we're looking at the financials, you can see that one quarter in early 2024, the sales actually declined. They were starting to see price pressure, and they were growing at a like 20-40%, right, before, and now they're shrinking, or not shrinking, but growing at a much slower rate. And because of some of these price pressures, they're actually their earnings were declining during early 2024. So that's why the stock had revalued, right? That's why the stock price came down, the valuation came down. And then in late 2024, the 3Q earnings came out, and you start to see an improvement in the deliveries of the cars. And that's where you see this rebound in earnings. And that's why, because the stock was basically pricing in a no growth scenario, when you see the report, or when the market sees the report of that improvement in growth, the stock doubled. So that's something you can clearly see for yourself. And I know this because I had a student, we were looking at Tesla in early 2024. He brought it up, and we were analyzing the financials together and looking at the drivers. That's always what I try to train my students to do. And we could clearly see that, like, okay, so the earnings are contracting because deliveries seem to be slowing down. So I asked him, okay, so what do you think is going to make deliveries improve? That would be the reason to buy the stock. So he does this research and he comes back to me and he says, literally, I think that we're probably going to get an interest rate cut later in the year that'll make it easier for people to buy cars on credit. And China's been in a bit of a lockdown in 2023 or 2022 and 2023. They're coming out of lockdown. They're probably going to be spending more. And so what do you know? If you look at some of the news reports later, obviously interest rates got cut. Now cars are being bought again because it's a little bit easier to buy it on credit, especially in the US. China reopened and growth improved there. If you look at the financials in Tesla, you see that there's big growth in deliveries to China. So that tells me that anyone can do it, right? It just takes a little bit of research. You just have to be educated in the same way that professional investors are, and in the same way that they think. So last question, what kind of tools do you need and information to do this? Now, it might surprise you, but almost everything is public. I mean, everything is public, not almost everything. But it does not mean you should be doing what a lot of people do, which is study the stock charts and try to look for patterns and invest that way, or even just follow random opinions, or when someone says, buy this stock because it's so great. Like, you should not do that. Instead, what what I suggest you do, and this is what I used to do as a research analyst, and I still do, is pretty simple. You just read filings on the company's website, go to the investor relations page, read the 10K, understand the business. It's helpful to have a data terminal like this so you can just quickly look at financials. I like to look at all the transcripts and read what's going on from the earnings call, read what's going on in company conferences, which gives you an update. And the point is, when you do all those things, you start to get an understanding of what the business is like. And then when you want to go really deep, and this is where you start to understand how to price and value stocks, you might put together something like this. Like this is a model that I built for Paylocity. So this is just, it looks a lot more, it's actually much more simple than it looks. But what it's really doing is just calculating my expectations for the future earnings of the business. And I can value this that way using different sort of methodologies to come up with a price target. And then that's how you start to analyze the data, put together financial projections, and start to think through different scenarios. And so this is hopefully not to dissuade you as well, because, I've done this a bunch of times. And, after you understand how business earnings work, you don't need to do this kind of intensive Excel stuff all the time. Like most of the time at this point, I can just read a little bit, maybe like 5-10 minutes, can probably screen out most companies. And again, all you need to do is just 1 out of 25 is going to be really great. It just takes a little bit of time to learn, to understand what to look for. So therefore, the takeaway here is that there is no barrier to you to do this. People aren't smarter out there. It's just better information processing. You have all the numbers, you have all the information to look at, but what you're missing is just a way to analyze a business, and getting into the habit of forecasting and valuing businesses, and then seeing how it all fits together. And, I wish I could just give you exact things to look for, but I can't because, companies change. Great companies change every cycle, right? And everyone also looks for different things. It's just some people prefer growth. I really like growth. Some people like just look at value. I invest in value as well. But you look for different things based on what your kind of overall strategy is, and that is dependent on what your personality is like. So this is why I don't really like to give you look for this specific thing, and those are usually really misleading. Rather, what I'm trying to help you understand is see how it all fits together so that you can do it yourself. So I would suggest, if you want to get deeper into this, the next video that's going to be suggested, you can see how it's actually done. And I hope this is helpful for you. Let me know in the comments, and I will see you in the next video.